CEO 5 times. I have won 3 Turnaround of the Year awards, delivered over 500 million of EBITDA improvements.
Over 50 million, and also subsequently 6 times the EBITDA number. So I'm not going to let you leave without telling us what that was all about, Brian.
So, in my career, obviously I've seen the worst, right? Every other area of the P&L, we really took a laser focus to how do we do things better, cheaper, how do we eliminate extraneous costs, et cetera.
Welcome back to the Raw Selection Private Equity Podcast. Joining us today is Brian Cassady, an experienced chief executive of a private equity-backed setting with a wide variety of industry experience. Brian has some serious accomplishments that he shares in the podcast, both working with private equity firms in an operating partner setting, but also in a PE-backed setting. One thing he does share is that he has increased EBITDA by over 500 million. Now, that is a significant, across his whole entire career, 500 million additional in the EBITDA is incredibly impressive, alongside turning businesses from minus EBITDAs to positive ones. Recently, as we discussed in the podcast, 50 million of additional revenue in a business of completely organic growth in a very short period of time, whilst also 6 timesing the EBITDA. So without further ado, let's welcome Brian to the podcast. Thank you very much for sharing your insights, and let's jump in. So Brian, if you could give us a 60 to 90 second breakdown of you, please.
Sure. My name is Brian Cassady. I am now an independent CEO, PE CEO for hire. Basically, if you go back through my career, I started off as an investment banker and then a private equity professional. Went to business school, and coming out, I determined I wanted to go on a path of doing corporate restructuring and turnarounds. That was partially based on some work that I had done before I went to business school, but partially also based on a desire I had at that age to kind of have an outside influence on the outcome of companies and businesses and how they operated, et cetera, et cetera. So I went to work for Deloitte coming out of out of business school. I actually had wanted to work for AlixPartners, kind of the preeminent firm in the world, in that field. And at the time, Alex wouldn't touch new MBAs. So they said, go get 7 years of experience. Deloitte fortunately would. So I joined Deloitte's turnaround group, did turnarounds for them, both in North America and in Europe. Ultimately accumulated the required 7 years and went to AlixPartners and said, how you like me now? And they said, we do. So joined Alex and cut my teeth there. Got, a lot of great formal training there at some of, kind of the best, operational turnaround people in the world. I tend to focus on the operational side and not the financial side. That was a conscious decision. And also focus on opportunities within Alex that were, kind of mid-market as opposed to the large market things. From then, that just led to me being recruited then directly by private equity firms. I got recruited by Sun Capital Partners as, kind of a subcontracted operating partner to go into all their businesses and enact performance improvements, and also sometimes step in as an interim manager, in troubled company situations. And then ultimately I started getting tapped on the shoulder to do it, as a CEO in my own right, which was kind of my goal all the way along. And, throughout my career, I've been very fortunate. I've been a CEO 5 times. I have won 3 Turnaround of the Year awards, delivered over 500 million of EBITDA improvements, throughout my career. So, so far it's been a pretty good run. So, knock on wood, but, good success.
Very impressive. Thank you for that insight. What one mistake do you see either private equity firms or portfolio companies making, and what would you suggest to correct them?
So, in my career, obviously I've seen the worst, right? Because at least earlier in my career, I've kind of morphed to being more of a transformational, CEO. So I'm not always called for troubled situations. But, the big mistakes that I traditionally have seen in my career are things like, growing too fast, doing an acquisition, not integrating effectively, et cetera, et cetera. But, I'm not sure that I would call that a PE firm, private equity mistake, because oftentimes I think they're just relying on the management team, and it's the management team that falls down. I would say from the PE firm perspective, the one mistake that I see made fairly often is kind of a rigid adherence to a predetermined strategy or methodology. Private equity people are very smart. Obviously, they do a lot of due diligence. They've done a lot of homework. They've seen a lot of things. But too often, I think they tend to simplify, kind of a things down to a playbook or, a set of tactics that they use in every instance that don't always make sense. And I've seen it many times where something that's, seems, relatively innocuous or relatively basic and mundane can really damage a company. Like, give an example, part of a playbook, or at least a standard playbook are things like SKU rationalizations. I've been in companies where private equity firm had said, okay, well, here's the deal. We're going to do a SKU rationalization because that's what we do everywhere. We're going to do product profitability analysis, find the low performing SKUs, we're going to cut them. And I saw that in a business that I was running where the private equity firm had done that. The margins in the product lines varied from anywhere from kind of like the high 30s to, the high 40s. And they kind of blindly went through, did the analysis and just said, okay, anything below a certain level, and it was a decent level. It was like anything below like, a 40% gross margin, we're going to cut. Well, it made no sense. Because, it's not like they had losing, it's not like they were losing money on those SKUs. As a matter of fact, they were making good money on some of the SKUs they wanted to cut. But, they had this kind of hard and fast rule. That's what they did. So they said, look, you got to follow it, go follow it, do it. And, what happened, and this is before I came on board, but, I kind of had to deal with the fallout. What happened is they had a lot of customers who, maybe weren't buying a lot of some of these SKUs that were making a lot of money, or, or maybe they weren't making a ton of money on some of these SKUs relative to the other ones, but first they were making money. And second, the customers needed them. So, as soon as they opened the door for this and they, pulled the rug out from under a customer and said, we're no longer going to deliver this SKU for you, we're discontinuing it. The customer needed that product for their production. And all of a sudden they couldn't get it. And they were left in a lurch, left a bad taste in the buyer's mouth, left a bad taste, in just the overall organization's mouth, because now they had to scramble on their end. And ultimately led customers to say, you know what, we're not sure you're really dedicated to us. This is the same old song and dance we've heard from all the private equity firms. They always come in, they do this, and we're going to go find an alternative supplier. And even though, maybe we didn't lose 100% market share, but, you lost the customer needlessly over wanting to do kind of window dressing around having done something that we always do, as a matter of course. And I've seen the same thing over and over in different areas too. Personnel decisions. I've seen it where, there's a preconceived notion around who performs and who doesn't, when you buy a business. Mm-hmm. And, perhaps there was a aspect of the business that struggled before an acquisition and, led to some profitability issues or some customer losses or whatever. And, private equity firms sometimes are quick to put their finger on exactly who is the problem, who there needs to go. And I've been in situations where I walk in and start working with the personnel and you find out maybe that's not the full story, or maybe that is the story, but maybe there were circumstances around it. And you start working with people and end up being great performers. And I've still had private equity firms say, no, that person's got to go. And you're left scratching your head saying, well, wait a second, I just had this guy, maybe when I first came, maybe he wasn't a top performer and maybe needed some coaching, but, has gone on to, it dramatically improved productivity in his workforce, has reduced, the headcount by 20%, has offshored another, 30% of the labor, is, spread continuous improvement throughout the organization. And you still want to get rid of this guy, so those are the kind of things that I think, private equity firms often do is they kind of, sometimes I think they get a little myopic around the decisions that they've made. And because they're removed from the circumstances, the day-to-day, and aren't able to kind of pivot quickly, I think sometimes they cling to decisions that they've made or methodologies that they followed in the past that they've applied successfully without thinking about, kind of the real here and now, efficacy of those types of instructions and, those types of actions. And I think it's especially damaging when it comes to things that involve the customer, because all too often I find there tends to be an inward focus of, okay, what do we do to optimize an operation, or what do we do, to improve margins, et cetera, et cetera. And, unfortunately, if you don't have the customer in mind when you make those decisions, a lot of times, you can win the battle by increasing your margins, but lose the war by alienating customers, forcing them in somebody else's hand. And I think that's where a lot of times, unless you're on the ground, like, the operators in the business and truly understand the customer implications, it gets a little dangerous from afar to make those kind of decisions and, those mandates.
Sorry to interrupt. Just a quick mention of our long-standing partnership with Grata. As you will probably know, the private equity scene is constantly evolving, and deal flow is moving now to proprietary and data-driven processes. Grata provides you with the data and information of over 7 million private companies. So if you're looking to improve your proprietary deal flow and improve the data access, then reach out to Grata today. Now back to the podcast. It's interesting what you're saying. I agree with, not every firm, of course, but there is firms in private equity that do make the mistakes you shared and do come to conclusions too quickly about the business or about the platform, about how they're going to operate, about how they've done things previously. And I think one of the things which you highlighted earlier was Sun Capital Partners and the operating partner role, and the more and more that we are seeing of that position, and that basically private equity investors are leaning on these people in order to make these changes instead of, or at least guide these changes and guide these decision-making process, because they've been there, done that, worn the t-shirt, and now they're in a coaching role, consulting role, if you wish, in the private equity firm, supporting the portfolio and guiding the decision making. Whereas it's difficult when you're the one under fire, if you're a chief exec or a CFO, for you to influence a different decision when it's perceived that they are the ownership, of which in the majority of the time they are, and that they have majority decision making process. So I think it's really interesting that we're seeing that, and we're definitely seeing that more in Europe. More in the US than we are in Europe from an operating partner position. They call it portfolio director in Europe in the most part, but Sun Capital Partners is a business that have championed that from very early on and done incredibly well with it. So that's certainly an area I've seen, and I completely agree with you on that.
Yeah, and I'll tell you, I mean, Sun, when I was at Sun, they did a great job. I thought they were really world class when it came to kind of coaching and mentoring and moving their businesses in the right direction, that sort of thing. And I understand as well too. There is an inherent tension. Don't get me wrong, Alex. Private equity professionals in general, operating partners especially, are under tremendous pressure. To make changes, to make something happen. I think a lot of them. It's an awkward position to be in when you're sitting on the outside looking in and you feel you're being tasked with driving results, yet you don't have frontline authority to do it. So I think there is a natural tendency to want to put out, to kind of tinker and put out edicts and say, let's do this, let's make a change, let's do this, that, and the other thing, in the context of them feeling that's their job to add value. But it's not always the case that it's necessary. I think that, all too often, in their zeal to kind of serve their investors, generate returns, et cetera, they just feel sometimes too much pressure to force, actions that, might not really might not be necessary, or, might be incorrect, but it sounds like we're doing something, so we're going to go ahead and act that so we can talk to an LP, we can talk to the deal team, we can talk to the senior executives at the private equity firm and tell them all the great things that we're doing, within a portfolio company, some of which, might not make sense.
Yeah, absolutely.
But, it's just like anybody, you're under pressure, they got to deliver. And, sometimes, that can lead to, extraneous behavior that is not necessary.
Yeah, absolutely. And I'm sure we're all guilty of that at some point when we don't have the full knowledge and certainly the full understanding. So you've mentioned a little bit in your intro about the amount of growth in business and what you've done, and the amount of EBITDA creation that you've had. And 500 million is certainly a big advert for anybody. Probably half of that, maybe even a quarter, would be a significant number. If we talk about the turnaround side of things initially, and then we'll go into the growth, but you've experienced some significant turnarounds in your career. One being, taking an organization from what I understand was the minus EBITDA, I won't mention any companies, but to the multi-millions in positive. I'm interested to hear if you can share what are the kind of 3 things that you've done during that process that have moved the needle kind of the most, that you'd be like, look, if I was going to another business, these are the 3 things we did in this business, and there's probably 3 things you should look for in the next one.
Yeah. So the first most important thing is just to understand and focus on where we are here and now. I think all too often when you're in kind of a troubled company situation and you're trying to set things right, people go into it saying, well, where did we mess up? What did we do wrong? And, that's important to inform your decision in terms of where you're going to go next and, how you're going to evolve the business to perform better. But, all too often it gets characterized as kind of headhunting and trying to figure out who to blame, et cetera, et cetera. So I think, the first thing that I always do is is step into an organization and let the people there know that I'm interested in knowing what the current state of the business is. And yes, I'm interested in knowing where things went wrong and maybe where we want to course correct. But I give everybody a pass for what's happened in the past. I don't care if you're the person who ran the business into the ground. If now you're the person who is going to step up and save it, then you're golden with me. I could care less what happened before. And, the reason I do that is because, one, I want a genuine snapshot of where we are. I don't want people hiding things. I don't want people, giving me, kind of their story on the way they think things should go based on what they've done in the past and adherence to trying to, repeat their mistakes to cover them up. So because admitting, reversing course and doing something different would be an admission of a mistake. I just want them to say, okay, bygones are bygones. Where are we at right now? What do we need to improve? And once we as a team get all that on the table in terms of where the improvement opportunities are, then it comes down to really good execution. So it's putting in place metrics, putting in place the action plans, and holding people accountable, holding everyone in the organization accountable for pulling their weight and delivering, in their fair share of the results. Whether they're kind of frontline, let's say it's a manufacturing firm and it's, okay, you're going to improve the productivity and, in the plant, and you're going to reduce waste or improve quality, or whether it's the HR department, which is, hey, we need to reduce our turnover. That's killing us. We've got too many people filtering in and out of the factory, or we've got too much turnover in our sales force so that we don't have continuity with our customers, et cetera. Whatever your piece of the puzzle is, it's measuring that continuously, putting in place goals, putting in place measurements around activity to achieve those goals, and then ultimately measuring the goals themselves and saying, are we where we need to be? Did we lower our turnover rate? Did we improve our safety? Did we gain new customers, et cetera, et cetera? And if you're not, then reevaluate the tactics that you used, right? So, if we're not making progress, you got to get back together and say, okay, we thought this was the greatest idea ever, to kind of fix and go in the right direction. But obviously it's not getting results. So let's admit that, and let's figure out is there a plan B or a plan C, or is there a tweak to the plan A that, would deliver better results? And, that's really what I try to do, is kind of keep an open mind. I know it's a really generalist answer, but quite frankly, I think it's really dangerous to go into a situation and make a bunch of assumptions around exactly what needs to be done. It really comes to marshaling the whole power of the team, motivating them to, be part of the solution and, participate in a turnaround process. And I think that's why I've been able to get really great results, is it's not just Brian Cassady going in and saving a company. It is Brian Cassady and whatever the size of the workforce is. My goal at the end of the day is to have every single person in that organization coming in every single day with a mindset of, I have my day job to do, which is whatever I do, wherever I fit in the puzzle, whether it's I'm turning a knob, whether it's I'm doing accounting, whether it's I'm on the production floor spitting out, I'm generating sales. It's that, but it's also every single day, how do I do it better? Or how do we differentiate ourselves from the competition in the marketplace? Or what do we do as an organization to evolve more and continuously improve? And I think, when you get to that level where everyone is coming in every single day with that mindset, it's just incredibly powerful. And that's really how I've been able to turn companies on a dime, because it's not me coming in and saying, okay, we're going to do these 5 things and then that's success. It's me, but it's also 500, 1,000, however many people there are in the workforce. A certain percentage of those people, you're not going to touch them all, but it's a large percentage of them thinking the same way and applying the same logic and coming up with great ideas to execute on to improve what the business does every single day in a bunch of little ways.
It's amazing how many things come down to the cultural aspect of the business and setting those standards. Not only am I the host of the Private Equity Podcast, but I'm also the founder and managing partner of Raw Selection. Raw Selection is a private equity specialist executive search firm with 2 divisions, one that focuses on portfolio, C-suite executive hires, and one that focuses on private equity direct hires of your back office and investment deal professionals, operating across Europe and North America. A unique offering of our service is that we offer a full money-back guarantee on all upfront deposits. We typically take around $10,000 as an upfront deposit to commence the search process. The remainder is then on completion, but that upfront deposit is completely refundable. If you're not happy with our service, we will refund that upfront deposit, no questions asked. How do you create? It might seem simplistic, but if I'm thinking, if I'm in your shoes, Brian, and this is the first gig I've had, how do you create that level of accountability? Now, obviously, they're going to be communication level, but how often are you communicating with people? How often are you holding people to account? And how do you do that? Is that conversational based? Are you using, KPI charts on the wall? What are some of your tools?
So, first of all, I like to do it daily. And when I say daily, I don't mean daily as in I'm out there daily saying, where are you at? What are you doing? But you got to create KPIs and metrics. I mean, you hit it on the head, Alex. You got to create your performance indicators, and you need some kind of daily performance indicators. And then obviously not all processes can be measured daily, right? So you might have weekly or monthly, et cetera. But you need as frequent as possible measurements and wide communication of results around operating metrics, and then obviously financial metrics as well. Your monthly financials, if you're lucky enough to have interim financial information, you'll get that as well too. But that information needs to be disseminated widely, and it needs to be focused on. So I'm big on generating flash reports. I'm big on having visual management tools where the information is all out there for people to see. And whether it's at the water cooler or whether it's right there on the production line, that information is there, and people kind of know what they're supposed to deliver and what their goals are, and they're striving toward it. Because without information and without data, to measure yourself, you're kind of flying blind, and you may get to the right place at the end of the day, but you're just as likely to be disappointed when the actual results come in and say, how did that happen? Whereas if you have your intermediate measures, your operating KPIs that you can manage to, you can at least know whether those are heading in the right direction. And if you formed them properly, usually you can form kind of a direct correlation between activities, operating metric performance, and then financial performance, as long as you do it properly. So, it's that. And then, it's also a lot of public recognition. I love to celebrate it because I think, those celebratory things, those events, and those words of encouragement, and especially in a public forum, I think go a tremendous way to motivating people to want to perform better, and wanting, and people feeling good about what they've accomplished, and getting a positive reinforcement loop where they say, okay, that was fantastic, I want to do that again. And or someone else who sees it and maybe isn't performing and gets a little jealous and says, wow, well, I can perform too. And maybe they haven't yet, but it's a polite way of, without going and calling them out on it, of having them realize that, hey, if I really think I'm the cat's meow, and I really think that I can perform better than the people around me, here's my chance to demonstrate it, and everybody will see it, and everybody will recognize it. So, that's really how I try to create that culture. And there's a lot that goes into it beyond that. A lot of training. You just can't expect people just to start performing just because you give them data. Mm-hmm. So, you have to do a lot of training around interpreting the data. You have to do training on continuous improvement. You have to do training on whatever their particular area of expertise is, sales training, et cetera. You have to arm people with the appropriate skill set, and you can't assume that they have it to begin with. But that's part of the process of figuring out, why are we not performing? If we're not performing because people don't know, how to perform, you got to train them up to do it, or you got to provide examples, or you have to, create some kind of system of guardrails around them that guide them in the right direction, so that it starts being embedded in their DNA, and the light goes on, and they say, aha, I get it. This is what Brian means. This is what, this is how I achieve results. It actually does work.
There's a great quote that's 95% of business problems are people problems in disguise. You talk a lot about people there. Is that, in your experience of seeing a number of organizations that either want to grow, either want to turn around some level of their business, whether it be revenue, EBITDA, or something else, do you begin with the people? Is that traditionally, or in your experience, where you find the change that moves the needle the most, rather than looking at we need to put our prices up by X, or we need to do this. And that may obviously be contributed, but is it mainly how do we get the ship righted with regards to the culture and the attitude of these people?
It's two things. It's the people and it's the customers. So, you mentioned a lot of things, and you're absolutely right, Alex. You can't just focus on the people and say, people, I'm going to develop you or want you to do better. It's always in the context of them applying some of the tools that you talked about, looking at saying, okay, well, why are my costs the way they are? Why are my margins the way they are? You just got to motivate the people to think that way, right? And to be constantly thinking, okay, how do I improve this? How do I improve that? If I'm a salesperson, how do I touch more customers? How do I improve my closure rate? How do I make them feel, my customers, how do I support them more with service and demand service from, the ops team, et cetera, et cetera. So, the people are important. It's important to get them aligned and thinking that way and making them feel empowered to actually change the outcome as opposed to feeling powerless. Because, a lot of times people feel powerless. They're one person out of 1,000. They really don't have an impact, or they have very minimal impact, or what they do is going to be negated by what somebody else does. You want to make sure they don't feel that way. And you want to make sure that they're motivated to, do their fair share. The other aspect of it too, though, that I think, you can lose sight of is ultimately, the people matter only to deliver for your customer. And if you're not delivering for your customers, some kind of value proposition, whatever value proposition you've chosen as your positioning, and you're not doing it more successfully than your competition, your people could be the greatest in sliced bread, you're going to lose them, right? So if you're following kind of a, premium pricing, premium service model, you better be able to back that up, and you better delight your customers, and you better be asking them what their expectations are that you have to meet in order to attain that goal of being the top provider. If you're the low cost, if your strategy is simply, hey, we're going to be the low cost competitor, and we don't care about all the bells and whistles. We're going to deliver, 3 flavors instead of 21. But that's the niche that we occupy. Then, you got to make sure that there's a customer base that really values that, and that's what they want, and they're going to reward you with it. And that base is big enough and it's profitable enough to make sense. But ultimately, you need to listen to what your customers want, because I think too often, there's a tendency, especially in a turnaround situation, to, focus on the internals of, okay, how do I make my revenues match my costs? The traditional way of doing it is saying, okay, well, I can control my costs, I can't control my revenues, so I'm going to focus solely on my costs. Which, don't get me wrong, that's important, right? I mean, no matter what, by definition, you're going to fail if your costs are exceeding your revenues, no matter what your strategy. But I think in the long run, you have to position yourself for success after the turnaround, right? Which involves making sure that you're not neglecting your customers, and that they can see that throughout the process, even if they're not happy with some of the things you have to do in order to get profitable, that at least you're doing it in a fashion that's going to leave them at the end of the day, in a better shape with you as a supplier to them than where they started, right? So it's those two things coming together, the people and the customers.
Excellent. And it may be that the answer is pretty much the same here, but if we move away from the kind of turnaround experience and focus on the growth side, I know from our prior conversation that you took a business from over 200 million, increasing 50 million, which is not uncommon in private equity. The uncommon nature of that is it's 100% organic growth and there's no add-ons in there. Now, that is kind of like the holy grail of, and we had, I think it was Matthew, I'm going to forget his surname, might be Graf, might be somebody else, but they gave us a statistic on the podcast, which was around 83% of all portfolio companies backed by private equity grow because of the market, not because of the work that private equity does, which is interesting if an industry goes from a 4x to a 5x or 7x or whatever, and that's where they see most of the growth. But, if any private equity firm, what can we do that's in essence perceived as free? It's not, but it's perceived as free. Organic growth. So over 50 million, and also subsequently 6 times the EBITDA number. So I'm not going to let you leave without telling us what that was all about, Brian. And if you can give us a bit of the keys to the castle, let's focus around the organic growth first. And I'm sure that ties into the EBITDA. It gives an indication as to what you implemented there and what you looked at to drive that kind of result.
Yeah, I mean, look, the organic growth that you're talking about, I think, you're referring to a company that I ran called Jason, and it's operate one of its main operating subsidiaries, Osborne. And the long story short is that it did involve a lot of what I just talked about, focusing on the customer and also having the people, in the organization fully aligned. But, as it relates specifically to the growth, there were several things. One, obviously customers want it all, and you got to focus on some of what's the most important things to do. And in that case, that particular case, we had to focus on, where were we failing the most? And it was very clear that where we were failing is we weren't delivering on time to our customers. Either we were late, or we were completely out of stock, period. Or in some instances, we didn't have the product anymore. We weren't producing it. We had elected to kind of prune it, et cetera. So you had to listen to the customers, and the customers saying, "Hey, look, the product's no good to me. I can't sell what I don't have." So we had to rededicate ourselves to on-time deliveries, and stock fill rates that were acceptable when they weren't before. And so that was part of the equation. Just simply by having the product that they wanted led customers to come back and purchase when before they wouldn't be able to, because they weren't going to get the product, so it didn't matter. So part of it was just better execution. Now, that took some sacrifices, right? We had to invest more in inventory. We had to adjust our processes so that we were more agile and were able to turn on a dime in terms of our production schedule and things like that. It wasn't as simple as just saying, okay, we're going to do better. There was a lot of work around it, and that's where kind of the people came into play. There was also, though, a lot of other tactics involved. One, we had to do a product refresh. Our products were a little bit stale, and the marketplace clearly was valuing innovation. So we had to determine exactly, which products we had that needed a refresh, and benchmark them against the competition, et cetera, and then go through our engineering function and, create kind of new and improved performance from our products, whatever it was, whether it was that the products lasted longer, whether it was that the products in that case removed more material, because we were doing, some abrasive type products and things like that, or, whether they were, had a lower cost, whatever it was, we had to determine what that key attribute was that customers were looking for, create a differentiation for us, right? And then go out in the marketplace and tell that story and say, look, here's our test results, us versus brand B, how do we perform? See, we're performing better, et cetera, et cetera. And then it was also introducing new products. There were some product line extensions, and also rounding out product lines where there were gaps in just the entire market. And we were able to look very succinctly at the individual market segments and say, okay, where's the gap? Where are our competitors not performing? What are the customers looking for? And, in a very targeted way, attack certain niches and certain segments and say, we're going to fill a need in the marketplace that's being overlooked. And, that sounds simple, but we actually had to do it across a huge, wide product line one, because the overall product lineup was pretty large, and there was no one segment that was kind of underperforming. So you had to do it almost like by 1,000 cuts. So we had to do this for 4 or 5 different segments, a bunch of different product lines, a bunch of different brands, but we did it in a fashion where we were very effective at nailing those types of opportunities. And that's kind of how we got that combined growth. It was a combination of better execution day to day, so customers felt better about us, could get the products they wanted, and came to us for those products and came back to us. And then also delivering into the marketplace what the market was demanding, but maybe wasn't getting because it either didn't exist in the market and we had to come up with a new product, or because a competitor maybe had a weakness that we could exploit. Maybe they didn't have good lead times, et cetera, or they had a cost problem, and we were able to come in, slightly below them, more favorable to the customer, et cetera.
So that gives us an insight as the organic growth, and also a little bit of insight into EBITDA. But if we say increased inventory to private equity, they're like, oh, that's definitely not going to increase EBITDA. So 6 times EBITDA, you've thinned out some of the product lines, you've made some changes there, you've introduced new products. But what kind of generated that? Where were some of the underlying areas that you were either surprised on or you would typically go for that would drive that kind of change from an EBITDA perspective? It doesn't sound to me like a change of product line would hugely change that. Obviously, increased customer spend would yes, but not hugely.
No, we did a lot on the cost side as well too, though. So, I like to attack, any type situation. I attack from both the top line and the bottom line, right? So the top line growth certainly helped because we just strictly added more dollars. We didn't increase our overhead. We added more dollars of gross margin to the bottom line, because we grew the sales. But then also, yeah, we actually improved our performance in every single income statement category as a percent of sales, with one exception, well, two exceptions. Material costs, because that was an inflationary environment and it was hard to keep up with the inflationary costs. So we were just about, we were almost break even there. We were about a push. And then also our freight costs had gone up. That was, during a period when freight costs were escalating, right? So we couldn't quite contain them. Every other area of the P&L, we really took a laser focus to how do we do things better, cheaper, how do we eliminate extraneous costs, et cetera. And what that involved was a combination of things. We did some offshoring where, we did really, we didn't do offshoring in terms of taking product out of our plant and just outsourcing it. What we really did is we ended up doing manufacturing footprint optimization, where we moved products within our plant network and took, products from one plant that, at one efficiency level, and we're able to move it to another plant within our network that had a lower cost structure or had better machinery for that particular piece of equipment or that particular product, et cetera. So we did a lot of that. We also did a lot of continuous improvement. I'm a big believer in continuous improvement. You don't find a lot of turnaround people talk about that, but the reality is I find that, actually continuous improvement efforts can start yielding benefits from day one. And I think there are an awful lot of companies that use, that as a buzzword. We use, continuous improvement, lean manufacturing, et cetera. They talk the buzzwords, but they don't really follow it. And everywhere I go, one of the first things that I do is say, we're going to embrace a lean culture and a, continuous improvement culture, so that we're going to start from day one with, training people on the techniques, training people on production methods and quality management, things like that, so that we fully know they really have the skills, and then demand that they utilize them to, deliver goods more efficiently, lower price, better quality, better safety, et cetera. So we did a lot of that as well too. We literally trained the entire workforce across, I think we had 1,500 employees, in continuous improvement, and then demanded down to the individual operator level that, people use the knowledge they gained in their training. And of course, not everybody did, but a lot of people did. And we were able to take out basically 20% of our manufacturing workforce just through continuous improvement efforts. And, that was on top of cost savings from, doing the offshoring and things of that nature. So, it ended up being a home run that really contributed to our bottom line and, really magnified the growth in revenues that we had, because we expanded not just the sales levels, but we also expanded the margin levels, the gross margins, and then therefore the EBITDA margins.
How do you incentivize? Because it's easy saying, guys, here's your training, here's information, here's tools. Doesn't mean they're going to execute on that. Doesn't mean they're going to do that. So we come a little bit back to the accountability question, I suppose. But how do you incentivize? How do you ensure that people are doing this? Do you give them the carrot? Do you give them the stick? Is it a mixture of both? What's the thought process there?
It's a mixture of both. I don't like to pull the stick out unless the stick is necessary. So I like to start with the carrot. And I think, interestingly, what I found is that a lot of times the biggest carrot to people is empowering them to do something. Yeah. All too often, especially in situations where there's underperformance, I think all too often people have a bunker mentality, and they're afraid of making mistakes. And they're afraid of making changes that can come back to haunt them if they get it wrong. So, what I really look for is opportunities for people to make suggestions for improvements, and then embracing them and executing on those improvements, and then kind of, talking about, what a great job they did, et cetera, et cetera. And I find that when you do that, you unlock a lot of potential in your workforce, because they feel energized. I mean, most people are discouraged when they come to work every day and they feel like they can't move the needle and they can't make a change. And, even all the way down to the production workers. I mean, I literally, I have lunch with production workers on a routine basis. I have scheduled lunches where I say, okay, I'm going to have lunch with a dozen production workers. You guys can volunteer, or I can pull people off the floor, but we're going to go and we're going to have pizza, and, we're going to discuss this, or if it's, in a service environment, field workers, whatever it is. And we're going to talk about what they do every day. And you would be shocked at what great ideas people have that they feel are going to fall on deaf ears. So they never say a word about it. And they just continue doing the same thing every single day. And unless they're told by somebody at a very senior level in a lot of organizations that their input is welcome and that that they will be rewarded. Now, the reward might not be, hey, look, you get a huge bonus or whatever else, or it might be. But no matter what I find is the biggest reward to them is an intrinsic reward. It's really, hey, I feel good because I made a difference and I got praise within my group, within my production cell, within, my production bay, within my plant, from the CEO, from everybody else saying what a great job I did, for coming up with this one little thing. And it may have been something small, right? But it doesn't even matter how big it is. If somebody did something that saves $20, okay, that's fantastic. If somebody does something that saves $250,000, even better. But you still treat it all the same. Somebody came to work that day, made a difference. It was a positive change, and you pat them on the back. And then at the senior levels, of course, you're going to tie it more, profit sharing and, things to, to EBITDA, so that that your senior management team feels it big time, in their pocketbook, and are looking at moves that they make and also moves that their colleagues make to improve margins and improve sales, and thinking, okay, what does that mean to me at the end of the year? What kind of bonus do I get? What kind of raise do I get? Et cetera, et cetera. And I try to communicate that every single month. I literally tell my team, look, this is what you're in line for bonus-wise at the end of the year based on the performance. And by the way, here's something that so-and-so did. Last month they renegotiated a contract. They won, some business, et cetera, on, for the rest of the year, this is what it's going to generate. And this is literally what it means to you as an individual and your bonus money at the end of the year. And I find, that, of course, is very motivating for senior managers because they can really put their finger on it. And they can see from month to month how their actions and also the actions of their peers impact them, and how they and their actions impact their peers. And it creates a really good, kind of sense of camaraderie and a little bit of peer pressure too, to perform and all add value. And that's really how I incentivize people, to do, to perform better and deliver those kind of results. It's a combination of positive reinforcement in a very public fashion, and also at senior levels, of course, monetarily. And you cascade the money down all the way down to the bottom if you want to. Sometimes you got union contracts that won't allow that, et cetera, that intervene and what have you. And obviously you have to worry about, being not just giving away all the profitability that you generate, but nevertheless, it seems to work pretty well. It's worked well for me.
Well, there's no argument with that, and I appreciate the level of detail that you've gone into there. What are your influences, Brian? What do you read? What do you watch? What do you listen to that you'd recommend that others check out?
So, on a regular basis, I don't have that much time to, to go out and listen and that sort of stuff. What I found, I've been in 36 different companies in my career. So, whether it's been on the consulting side or the CEO side or the PE side. So I've gotten to see a lot of different things and work with a lot of different professionals and learn that way. But I think that the number one influence that I had, probably that I would recommend to anybody is there's a book out there. It's a very old time-tested book called The Toyota Way. And it's all about the Toyota production system and their philosophy. Yep, you probably have it on the shelf. I think
pointing at it right now. Yeah, absolutely.
Yeah, I think everybody should have it on the shelf. And the thing that I really like about the Toyota Way is, when people think about big companies like Toyota, and they have their operating systems, and they figure, okay, this is going to tell me all about how I manufacture something better. It's not really. I mean, it starts. It really starts with, okay, the kind of customer servant mentality all the way through the chain, starting with the end customer, the auto consumer, and cascading all the way down through the design team and through to the sales team, and then down to the production team, and then down to the supporting functions. And in a very, very succinct way, describes, kind of what I would view as kind of world-class management of how to manage a company to excellence so that it's performing extraordinarily well in the marketplace, that it is also doing very, very well for its investors, is a good corporate citizen to its suppliers and to its employees, and also to society in general. And, I think that kind of message gets lost. People think, okay, well, this is all about, how do I improve my throughput and how do I reduce my cycle times? But actually get into that book, it really goes much, much beyond that, and gets, into strategy and into delighting customers, and, describes how Toyota has done a fantastic job of creating an operating system that really links every single chain, every single piece of the supply chain, from a Toyota worker to a supplier worker, all the way on through to the products they produce, going into an assembled car and out to a customer in such a fashion that the customer is delighted when they're driving it down the freeway, and it's got a smooth ride, and you hardly hear any noise, et cetera, et cetera. It's just a really, really great narrative on kind of anecdotal stories of how Toyota's been able to achieve what they achieved in their heyday.
Yeah, and the message I would put out there is these books and these processes and all these systems, they might come from guys like Elon Musk and read his biography in the Toyota way. And you're like, no, these are big organizations, but it's much easier to implement these things when you're small. You've done it with some pretty large organizations, 200 million plus revenue business, and implementing these systems, with hundreds, maybe even thousands of employees. For some organizations is a lot harder than doing it with 10, 15, 20, 30, 40, 50. So it's well worth implementing. So Brian, you've shared a lot of information. If anybody wishes to reach out to you, and if I was out there as a private equity chief exec, I'd be definitely blowing up your phone. What's the best way somebody gets in touch?
So the best way to get in touch is probably by email, and you can reach me at brian.cassady@blackadvisors.com, and that's BRIAN.CASSADY. And Black Advisors is spelled with an ORS at the end. So you can reach me there. You can find me on LinkedIn as well. I'm pretty easy to find out there. So, those are probably the best ways to get in touch with me.
Perfect. We'll put that all in the show notes. So, Brian, thank you very much for coming on. Thank you very much for sharing everything you've shared. You've shared about growth. You shared about turnaround. We've discussed lean. We've covered a ton of topics, but all around growing private equity backed portfolio companies. So thank you very much for everything you've shared.
Okay. Thanks, Alex.
And as always, thank you very much for everybody who's listening. Should you ever need private equity professional hiring or portfolio executive hiring, please reach out to us at Raw Selection. And if you've not already done so, podcasts like this are now coming out every single week with the Raw Selection Private Equity Podcast. But till the next time, keep smashing it, and thank you very much for listening. Brian, that was exceptional. Thank you very much.